Hey guys, this is Nate Dodson. I'm here with the best attorney that I've ever met. Ah, yeah. And I literally had to drag him kicking and screaming and yelling. But
That's
you know what?
true.
We're talking about something so important today. But please allow me to introduce Jeff McConnell. Jeff has been working with crowdfunding lawyers, well, a lot longer than I have. So Jeff, please introduce yourself. And you know what, maybe if you really don't mind, could you tell a little bit about kind of your experience with crowdfunding lawyers now and, well, before Richard and I became involved?
Yeah, sure. So unhappy to be here. Just kidding.
He's a
Happy to
liar.
be here. um, I've been, geez, I don't even know how long I've been working with crowdfunding lawyers, a few years, 3 or 4 years. Started back when Jillian Sidoti and Gene Trowbridge were running the firm, along with Nancy Tegeter was a lawyer with the firm at that time. And yeah, got my teeth cut with them. With COVID and a lot of other changes, you know, Gene and Jillian went their separate ways. And eventually you and Richard stepped in and bought the firm. And it's just been an ever evolving situation so far. So
That sounds like a okay, yeah, still moving along. But no, just a real quick story, and then we're let's dive right into the ever important how to be more successful with raising capital. You know, we've got a Ukrainian family that is staying with us right now. Literally, with the war and everything, I helped them get from Ukraine, Poland, Germany, Cancun, where they enjoyed the beach, Tijuana, San Diego. They just landed in Dallas. Husband, wife, 3 kids, and this is all very real. You know, they have no home, but you know, getting to know them, they don't speak the best English, and they understand that my wife Jasmine and I are liars. At least that's the way that they pronounce it. Trying they're still working on their English. So they're just like, you liars. And then we're just like, yeah, basically that's kind of our job description. So they are in the process of learning English, and they're even staying with us with their 3 beautiful kids until we help them get situated. But let's move on to some really fun and exciting problems that clients and people that are doing deals can really kind of create for themselves. And please, at the end of this, we're going to answer any questions that you may have. Parker, amazing marketing coordinator, is just kind of watching out for everything. So if you have questions, have comments, have better jokes than I, please put them in the chat and really appreciate it. But Jeff, there's so many ways that honestly our clients can make their lives easier, the sales process easier. You know, just I know we've got 10,000 different things that we could talk about for the next 10 years, but really kind of top of mind, what are an area that you think that, well, people get in their own way?
You know, the biggest one I could think of is probably like making their distribution scheme too complicated. A lot of times, you know, people want to look sophisticated, I think, you know, and sometimes they get in the weeds a little too much with how they have their distribution set up, when really they should kind of be going the opposite direction, making things, you want to make the deal sellable and easy for investors to understand. And generally that means having a simple distribution scheme, in my opinion.
I love
Sometimes it makes sense to, complicate it a little, make changes, but in general, I think simplifying that is the best action.
Very much in my experience, couldn't agree more. I was literally talking to one of our clients, and we're talking about the napkin pitch. If you can't explain on a napkin the structure of what's going on, you're gonna lose right over the head of so many of the investors that the KISS method, keeping it simple, stupid, absolutely makes sense. And the napkin method is at least kind of what we had talked about. Like if it takes pages, and literally I've done some of these that it's like 4 pages, 5 pages of distribution waterfalls, and it can get really ugly. When setting these types of things up, what do you advise?
Generally, preferred return and a simple split after that is, I think, the best way to go. And some people even choose to forego a preferred return. Kind of depends on your specific deal and the returns you're expecting. But I think a pref with a split is a good start.
Just for the benefit of everybody, what's a preferred return?
So a preferred return is basically a return that the investors are going to get first before any money is split with the sponsors. And usually it's cumulative, which means if in a particular quarter there's not money to pay it, it'll accumulate until there is money.
Got it. And in terms of range, and of course, it's usually at like a percentage. And since you brought up cumulative, and I'm just jumping all over the place, non-cumulative, is there ever a time? And cumulative means that it just adds up if you can't pay it. Non-cumulative means if the company can't pay it, investors lose it. Mm-hmm. And they just get paid their preferred return when they have the cash available. In your experience, is there a good time to include a non-cumulative preferred return?
Generally I don't like them. But I mean, they're a little safer for the sponsors. I mean, if the money's not there, you don't have to pay it. If it is there, the investors get it first. So it's definitely a little bit harder to sell to an investor.
I couldn't agree more. I at least in my 2 cents opinion, definitely less sellable to the investors. But if you're ever talking about like a startup business or a ground up development build, the things that always take longer and cost more, right? Just the fact of doing deals consistently, it's better for the company, it's better for the sponsors to agree to non-cumulative. Definitely not in the investors' best interests.
Yeah.
Along those lines, well, do you have like a range of preferred returns that you encourage people to think about, or not really?
I think, it kind of depends on what split you're thinking about, but usually we see anywhere from 6 to 8% as a starting point, and the split after will go up or down, kind of depending on where that preferred percentage is at. So I think like as a starting point, like a 7% pref with a 50-50 split is a good starting point, and you can kind of move it up or down from there.
Got it. So like preferred return goes up, profit split goes down, and vice versa.
Yeah.
Do you ever use like, preferred returns on the front end? Mm-hmm. I sometimes really I call them performance hurdles on the back ends. Really, when you don't have a preferred return, do you ever think about that or incorporate that with kind of the strategies that you advise and help people with?
Yeah, sometimes a lot of times, I don't know that I suggest them a lot, but a lot of times we have sponsors who want to put those in there, and it can make a sellable point for the deal, because they know like, hey, this sponsor has a motivation to perform, so they get paid.
Bingo. Well, to give kind of the way that I do end up using when I'm coaching clients with their structure these performance hurdles. If somebody doesn't want to have a preferred return at all, just have a profit split, then that's great. And it's wonderful on the sponsor side, which I'm a fan of, because that means our clients are getting paid throughout the process without having to hope that the deal meets and beats the preferred return and then profits.
Mm-hmm.
But I always suggest at least thinking about a performance hurdle, because let's be honest, if the whole project goes through its life cycle, it's time to sell. And if the investors don't have at least some reasonable return, they're not going to invest with you again.
Yeah.
So that's really the way that I use it, is saying, okay, well, if you don't end up getting a 8% return overall, Mr. Investor, when we go to sell the company, sell the real estate, if you haven't hit that, no problem. We're going to make sure that you get that, and then we'll get our share as well. So that's at least part of the stuff that I think about. Thanks so much. In terms of other headaches, and let's go with, this is going to be fun. Attorney-client confidentiality, absolutely the most important thing in the world to us. But you got any crazy situations that you're juggling now that we can generally, high level, talk about, and just kind of ways that really our clients could have and should have made their lives easier?
Let's see here. So, well, it's tax season, right? So around tax season, we get a lot of tax questions from people.
Yeah.
And I guess a suggestion I have in general, and this really doesn't apply to any particular client because it happens a lot. But when you're reviewing your documents, have your CPA review the tax provisions of the operating agreement. Our tax provisions are tax professional reviewed, but that doesn't necessarily mean they're tailored to your specific deal, your specific goals. And really, that's not something that we can specifically help with. We're not tax professionals. We can give limited advice, but really your CPA should be looking over things. They know your tax strategy, and it's much easier to kind of tailor that on the front end rather than the back end.
Couldn't agree more. I'll say the generally included, well, at least since we took over tax allocations, I always run them by a tax attorney as well. CPAs, it's kind of like bookkeepers give some level of service. CPAs know a whole lot more, but I'm always trusting the tax attorney.
Yeah.
So that's where we do have our variations that we use that have always had tax attorneys look at them. And, when somebody says, well, let's do this, that, and the other, I at least go with the very classic, that sounds excellent. Let me introduce you to a tax attorney that can make sure that you don't get yourself in trouble.
Yeah, exactly.
So, and along those lines, it's tax time. K1s are already due. Do you know when K1s had to be sent out and delivered to everybody?
March 15th, I believe, if I remember.
Oh, you nailed it.
Don't ask me tax questions in front of people, Nate.
I know. So, well, let me just preface this for everybody that is listening. We are just rolling with it. So I'm going to completely surprise them every once in a while. So I apologize, but I'm going to do it again and again and again. Well, then I'll talk a little bit about that. So, K1s are already due. K1s are supposed to be out. If they're not, talk to your CPA. They can generally get waivers of penalties from the IRS. It's almost like as long as you're not consistently doing it over and over and over, they don't need to be the bad guys. But talk to your CPA. Remember, CPA, best friend. Jeff, necessary evil.
Yeah.
I say that, but no, really, I mean, the reason why you should be hiring transactional attorneys, securities attorneys, real estate attorneys, is just so that you're not hiring the litigation attorneys who cost way more than we ever would later on. So, if you don't mind, one of these other headaches that I'm get to play with and deal with, investor suitability. So, and what investor suitability, it means, well, accredited investor, non-accredited investor, that's kind of a starting point, but even getting a little bit deeper. And let's stick to this Reg D 506B, unaccredited, sophisticated investors can be allowed. If you have a client that's really trying to be aggressive, best practices, what do you advise in terms of who they should expect or accept as an investor, and what kind of person is suitable?
Yeah, so, well, 506B, so first off, generally, you're going to have a pre-existing relationship with the person. There are some minor exceptions to that, but we're going to assume for this discussion you do. So, I mean, what does that mean? Are you going to, admit grandma and grandpa, or, are you looking more for business associates, Uncle Jerry? It's a great question. I mean, really, sophisticated means what it sounds like in my mind. Like, do they know anything about investing? Have they invested?
Pinky out, drinking wine?
Yeah. It's like sophisticated in business matters is what I think of. Have they invested before? Are they green, brand new to investing? Do they have a background? Like, are they attorney? Are they a CPA? Are they a broker dealer? What's their background, their history? It's a little more risky when you have inexperienced people in your deals. First off, they generally ask more questions. They don't understand things as well. They might not read your offering documents because they're confusing to them, and generally cause more problems. Really, you should have a really good idea of their ability to invest, ability to take a hit if the investment goes bad, and they should have some experience with investing, in my opinion.
Don't our subscription documents, every last one of them, say in there, I represent as an investor, I can afford the illiquidity of this investment. I can still maintain my lifestyle if I lose everything.
Yeah. So we definitely have, warranties in there that the investors will, check a box and say yes. But ultimately, it's up to you, the sponsor, to verify that information before you accept them. Because these people generally, and you should know most of the answers to those questions that they're answering, whether they're really true or not.
Love it. And my own always 2 cents, sophistication by education, by work experience, life experience. Also, and this is something that we rarely think about, they can borrow an advisor's sophistication.
Mm-hmm.
So if they have a financial advisor, or if they have a CPA that is reviewing and guiding the investors through the paperwork and through the documents, that actually can count as the investor's sophistication.
Yeah.
Big downfall, and this is, really, if there are ever audits, complaints, state SEC, they're coming down. I've been doing this a really long time, have hundreds, if not thousands of deals under my belt. Some absolutely, and they're not many, but some investigations occur, and it's almost exclusively unaccredited investors that really didn't understand what they're getting into that file the complaints. And the audits, they don't happen unless somebody's complaining about it. If life is golden, things are working out great, nobody's complaining. I learned from the guy that first taught me how to do securities, over a decade and a half ago. The best defense is a successful deal.
Yeah, it's so true. No one's going to complain if they're making good money. It's when that deal goes bad that, problems arise, and unfortunately some complaints do happen.
Bingo. No, I couldn't.
Well, and I was going to say, and you may have not even done anything wrong, but a complaint was made, and so now they're going to look into it. So,
you know what? I'm going to bounce off that. And, there's actually something to be said about the sophistication of our clients too. Education and knowing what you're doing in the realm of investments, as well as your business operations, really, really important. So, we do have our YouTube page with lots of education there, but in general, just get educated, go through the trainings, learn more. And I wanted to give you a little story about this guy, that client. We didn't actually do his deal. He was reaching out to try to, protect his family, and he really didn't understand what was going on. Real estate syndication, his first. He was partnering with his mentor, and the property wasn't doing very well. Well, it wasn't cash flowing. They needed more money because of taxes, because of this, that, and the other. So he got one of the investors actually gave him some money. Well, didn't give it to him, had him sign a promissory note that bound him, that took rights to a bunch of his distributions, all of this. Then here's where it gets crazy. They get to the sale, and the investors actually ended up getting a 26% annualized return. Nobody was paying attention to the fact that just because there wasn't cash flow coming back to them, the appreciation of the property was astronomical. And then this investor that lent the money to the sponsor, this investor was very sophisticated and completely took advantage of this guy, and actually ended up taking, more than half of what the sponsor should have received. I mean, it was like 70, 80% of it. And he was like, well, here's the terms. You signed off on them. This is what I want. So, and I hate to say it. My advice was, you can try to negotiate, but they've got a contract. You didn't get an attorney. You didn't get a transactional attorney to help you review and negotiate. And frankly, you didn't understand what he was signing, or he didn't really have the knowledge or experience to think through it. And he really got himself caught in a bad situation. So, very roundabout way of saying, if it ain't us, please make sure that you've got a good attorney backing you up on any component of business, because the cost benefit, the risk and reward, it's just too high. And our job is to give that best advice, whether you follow it or not. It is our job to give you that advice.
Yeah. Now, here's a question for you, Nate, and I'm sure you're probably thinking of some point of segueing into this, though. So a lot of people think 506B exemption, unaccredited investors, but you don't really have to accept unaccredited investors with a 506B offering? And I think a good question is, should you?
Here's the crazy thing. My opinion is the answer to that is always no, you shouldn't, but you are allowed under the rules. I hate to say that the rules are pretty ambiguous at this point as well. I don't know if you've dove into the SEC stuff and the actually what the 506B rules say right now, and how it just doesn't even really match up.
Yeah, it's a little vague. For those of you not super familiar with 506B exemptions, with unaccredited investors comes a bunch of disclosure items that you have to include that you wouldn't normally have to if you weren't accepting accredited investors. That includes non-financial disclosures and financial disclosures of the company. And a lot of those requirements, like Nate said, are pretty vague and ambiguous, really.
I just reviewed somebody else's PPM. It was a 506B, very specifically would allow some unaccredited investors. And you're going to laugh at this. It didn't even disclose who the management was.
Oof.
It did not disclose any use of proceeds. It was just this blind, there were a bunch of risk factors. Well, there were all these risk factors because those investors are really, really, really most likely going to lose all their money. But really, it was, I looked at it and I was just like, whoa, what are you thinking? Run away.
Yeah. So
but any investors that come into it, the benefit that they have is it's a bad PPM. The sponsors end up guaranteeing in their investments. They get these right of rescissions. They lose their securities exemptions. There's some major consequences of not doing it right.
Yeah.
And you're really nailing it. So let's 1031 exchanges. I know you've been dealing with quite a few of those lately. Is there something about 1031 exchanges that really it could be a lot easier and simple for the clients? There's so many of them that get proposed, move down the road, and then they don't work out.
Yeah. I think that kind of leads back to what we talked about with sophisticated investors and who you actually, let into your deal.
Uh-oh.
And it looks
Jeff,
like
I hate to say it, it looks like you froze up.
Yeah.
Oh, there you go. We see you again.
Looks like my internet's a little unstable. Sorry about that. But I was just saying sophisticated investors, so unaccredited investors are a lot more risky. So really think about who you're bringing into your deals.
One of the big things, good luck getting that fixed up. But one of the big things with 1031 exchanges, and just while Jeff is trying to look like he's not just simply surprised with the frozen screen, 1031 exchange, all it is if you have some asset, you can sell it, buy a similar asset, they call it like-kind property, and defer paying capital gains. It's fantastic in the real estate world because, well, you can just go from property to property to property, defer capital gains, don't pay the man, big man IRS guys. So it's great. One of the biggest hurdles I've always experienced with it are twofold. A, with the people that are doing the 1031 exchanges and have those rights, if there is debt on the property that they sold, there has to be debt on the property that they buy. If it's all cash, meaning they've paid off the debt, they can invest into another property that has debt on it. But then when they 1031 exchange to the next one, it would have to have debt on it. So theirs can create some tax and liability headaches. And secondarily, with syndications, okay, I gotta say, Jeff, you look hilarious. You're like, what's going on?
It's
With syndications, it's with 1031 exchanges, they come together through tenants in common agreement. They end up with direct ownership in the property, and they have more rights, more voting rights, more control rights, more authority than your traditional syndication or fund investor. So these are just the types of things to think about. There's always options there, best practices there. I hate to say that so often when I see these 1031 exchanges, they just don't seem to work out. Well, not 100% of the time. I'd go with about 50-50. So, you know, do you have any, we see you now, it's actually working.
I don't know. Comcast. Shoot.
What's your opinion on using crowdfunding portals or using the online portals for managing the investors in the capital stacks? Or, you know what, Jeff, I hope you get it figured out. I hope you are able to join with us, hop off, hop back on. And rather than just rattling off with things, please, if anybody has any questions, throw it in the chat. And you know what? I'm just going to start going through some of these questions in the chat while hopefully Jeff gets a great opportunity to join us back. So Parker, do you mind just reading them off so I don't have to try to pay attention to too many things at once? Oh, you're back. Well, we've already started with a question. Parker, please, let's go through the questions that are up here. And please, anybody, if you have additional questions, please put it there. Jeff and I will get back to kind of some of these structure and other issues, but really want to be the best benefit to anybody that's listening. So let's go through these questions, Parker, if you don't mind giving us a hand.
Awesome. You got it, Nate. So we'll jump in this first question right here. See, the person asked, like to know legal possibilities in an exchange of real estate. We have a 10-unit, 3-parcel residential portfolio to sell exchange for an equity partnership in a commercial asset class. I would give 10 units for a partner in their assets, multifamily storage or mobile home park.
So it does, hey, we just rolled right into that 1031 exchange situation. So you can 1031 exchange, but the big limitation with it is it sounds like he's trying to 1031 exchange directly into a partnership. And there's actually options there so long as the property is getting contributed into the partnership that they are taking an interest in. Jeff, do you know much about these Section 720 transfers? I don't even know if you can hear me. So I'll go ahead and just roll with it.
My internet is having serious issues right now.
Oh, no problem. Well, if it works out, chime in. If you get bounced, no sweat. So let's go with 1031 exchange. I've already started to talk about that a little bit. That involves the purchase and sale of like-kind property. When it comes to real estate, every piece of real estate is unique. So it works with real estate generally. If it's multifamily to single-family homes, single-family homes to storage, no problem with that at all. Now, it has to be direct ownership in the property. If you have an LLC that owns a property, actually the 1031 exchange rights is the LLCs and not the owners of the LLCs. There are ways that when you sell the property to allow some investors to get paid out, other investors to 1031 exchange together with the company into the next deal. Now, to really answer exactly what this question is, I'm going to assume alludes to, there's also, they call it a Section 720 transfer. And what that allows you to do, Jeff, is that property that you own, you can contribute it to a fund and take ownership interest in the fund, capital gain free. Now, you lost the 1031 exchange options with the property to the future properties. But if the fund is 1031 exchanging from one property to the next, it's still absolutely a possibility to accomplish that. Jeff, if you can even hear us, and this is getting to be comically entertaining, you have anything to add? All right, Parker, let's move on to the next question.
All right, the next question. I have a project that I'm looking for sponsors. However, a friend is asking 50%. I'm not sure what that means or what they're asking or how to set up the distribution. Any suggestions?
What have you done for me lately, Eddie? Yes, I mean, if a friend is asking for 50%, looking for sponsors, really, it sounds like they're looking for a partnership with you. Either A, are they coming in with the equity? Are they coming in with the needed cash and they just want 50% of the profits? If that's the case, it can be a phenomenal opportunity for you. If they're thinking more, just doing the, hey, we want to come in as part of the GP, the general partner, the sponsor, and we're going to help. Great. They can take 50% of, there's usually, they call it a carried interest. And that is the profit that the management receives as part of doing any sort of real estate project. I mean, you're not out there raising money from investors, buying properties, distributing cash flow as a charity. It's very important for the sponsors, for the GPs to make money along the way. Sounds to me, Tina, like your friend is asking for 50% of the sponsorship to help you successfully do your business. If they had the capability of bringing all the capital, frankly, it doesn't sound like a bad situation. There's other components to take into account, such as you may need loan guarantors, you may need other operating and management key principles and partners. And so you want to make sure that you don't hurt yourself and your interests by giving up too much. So definitely something to think about and negotiate with, but it does sound like they're on board to help you along for your own success.
You ready for that next question?
I am. Jeff, are you on?
I'm on. I don't know if you can hear me or if it's working though.
Next question, whatever it is, it's yours. And if you get cut off, I'm jumping in.
All right, let's do this. I hope you're listening, Jeff. We are doing 7 or more buildings in Florida using nest generation materials and techniques, modular panels, home in a box. We have funded the first one through a private investor and JV partnership. We have other investors that want to be involved, but don't have the full funding for one building. However, would like their money to continue to be used on future buildings. Is there a fund setup that would work to keep investors' money going from one building to another while also building their investment nest egg? And you can check the chat if you need to refer that question. I know that one was a little wordy, but it's there in the chat if you need it.
This is I'm rolling with it. Sorry, Jeff. Feel free to jump off if you want. I know it's not connecting very well.
All right.
So, and now I'm thinking, really, as I was saying at the beginning, he's doing this on purpose. He doesn't want to be here anyway. So no, I'll go ahead and answer that. And the long and short is absolutely, of course, you can put together a syndication or fund. Looks like you got a good connection now to do a multi-phase development project. It does have to be from the get-go built out that way, your investment opportunity, because it's the most important thing is really for investors to know what they're getting themselves into. And if it's a Regulation D offering, and there's other options there, you disclose, here's our business plan. We're going to do one building, then the next, then the next, then the next. And to be able to do that, they actually can do 1031 exchanges from the next to the next to the next. But it is very common to have a multi-phase development project that moves forward. So there's no problem with that at all. With your JV partnership, that I presume that there's really only one large investor that's in there. Now, to raise capital from multiple investors, you will always want to get your joint venture partners that have more ownership and more control to really be on board with the plan. You know, if you start raising money or doing things that, hey, surprise, we didn't know what we're getting into, that's where the regulators and lawsuits come into play. So at the end of the day, biggest thing is do what you say what you do, and then you're really not going to have any issues. Mr. Parker, I'm going to go with we will not see Jeff again. We'll miss him. But
It's looking like he's gone, unfortunately.
Yeah, no problem. These things happen. So if you don't mind, we'll just keep on rolling with the questions. Please
Cool.
keep
Yeah,
adding
we
them. I
actually
will
just
answer
got
as
one
many
more.
as I can till we get to the top of the hour.
Awesome. So the next one we just got in was, can you do a fund to raise the money for the future project that you don't know which project yet?
We call that a blind pool. We have a plan to raise money, or we are raising money. We just don't know what we're going to acquire yet. There are certain restrictions and requirements that go along with doing a blind pool investment. The biggest thing is it's difficult to sell that to investors unless you have a good track record, you have an audience to talk to. You know, as an easy suggestion, start with a syndication, start with a designated property or a partially designated pool, meaning, hey, we're going to go buy this property, go do this deal, and we plan to do more similar types of properties in the future. It allows the investors to kick the proverbial tires. And so it's not just about the what have you done for me lately. It is about more what's going on with that property versus that trust, blind trust with you as a sponsor in your operations.
All right, appreciate that. There doesn't seem to be any more questions at the moment. If anyone else has any other questions, now is the perfect time to ask them.
And if there's not, I'm going to talk a little bit about there's different types of offerings. And in preparing for them, there's kind of different processes. And specifically, I want to talk about Regulation A, Regulation CF, going public, and the different people and things that you need to be involved with that. Being prepared in advance, knowing what you're getting yourself into, honestly will save you money. make life a lot easier, because you don't want to start moving forward with your business plan and then realize, oh, I need to do all of these other things that's going to cost more money than I expected or budgeted and more time than I planned for. And I'm going to start with going back to accountants, the CPAs. For the different securities regulations, audited financials are sometimes, but not always, required. With Regulation D, not required until you go big. Once you're going big, they may be required if there are unaccredited investors. With accredited only offerings, going back to safety and suitability, you'd never have to get audited financials unless you voluntarily agree to it. But with Regulation CF, if you're raising more than $1,070,000, you always got to get audited financials. Even when it's a brand new company, it's never done anything. Maybe it has $100 in the accounts. You still got to get audited financials. And these CPAs, they got a great racket. They charge an arm and a leg. Same applies with Regulation A. You always have to have audited financials. And the one unique thing is, if you're ever going public because your business is doing awesome, because you are just expanding and growing, then it is they call it a PCAOB qualified audited financials. It is just a much more in-depth process. And that's where you do start looking at that $30,000, $40,000, $50,000 cost to receive audited financials. So that could be a major surprise if you're not ready for it. Other things to take into account are capital raising costs. And I'm not saying, hey, just hiring your friend to go bring in capital. There's a lot of regulations and restrictions there. However, they can, as finders, and a finder means, hey, I'm not getting paid to raise capital, but you're going to pay me for an introduction to investor, whether they invest or not. That's permitted. There's a lot to that. Make sure, again, you're always getting more thorough and best advice than right here from your attorney. But broker dealers. A broker dealer is actually a business that helps raise capital. All of these big Wall Street firms are broker dealers, but there's also broker dealers that focus specifically on Regulation A offerings or Regulation CF offerings, or other raising private equity for your investments. And just kind of a general statement, it's not cheap. If you are raising capital with a broker dealer, unless you've got a lot of experience, you've been doing it for a while, you're generally looking at an additional 10 to 15% on your capital costs, but that's with the broker dealer delivering investors. Even if the broker dealer is not delivering investors, there may be compliance broker dealers. I'll give you an example. If we're doing a Regulation A offering, there are some states that are just a pain to deal with. And you have a couple of options. We can help you coordinate with registration as an agent of the issuer with these 6 or 7 states. You can choose to not sell in those 6 or 7 states. Or the easiest thing, simply get a broker dealer involved. With the broker dealers, you're usually looking at about 1% of all the capital that you raise, 1% of up to a $75 million raise. It can add up, and it could be higher. It could be up to 3%, but it really, at that point, it's all negotiations, and you should be able to have a broker dealer that's representing your fund, only charging 1 point. On the Regulation CF side of things, it also can be a little bit different. Generally, you're going to see a minimum commission of around 4%. But even with that, it can get up to 10% commissions. The major difference between those 4% commissions and the 10% commissions is that crowdfunding portal doing anything for you? Are they marketing themselves for their marketplace that your deal is listed on? Are they marketing your deal, which is few and far between? Or are they strictly providing compliance services? When somebody says, pay me 3 or 4%, generally you can just assume that they're providing the compliance services, not necessarily actively helping you raise capital. So, all right. Parker, I'm not going to bug you. I did see David. Thank you so much for popping up with a question being, what's the best strategy with multiple investors in real estate to start a fund, create an investment vehicle as a mortgage note holder, or I'll say an equity syndicator. The problem with, well, I'll point out the good, the bad, and the ugly with these situations. If you are buying real estate and you raise money through private lenders, or you put together a mortgage note pool, great. If there's only one, then it's not even a security and life is easy. However, if you're also going to get traditional bank financing, traditional banks are always paying attention to the debt and equity. And with you borrowing money, that is going to cover a lot of it. There's debt and debt. So yes, you can absolutely find lenders that will do the first, they'll approve a second. Generally, they still want that skin in the game, that equity component of the deal. Not always, there are out there, but it is way more difficult to find. So that makes the mortgage transaction, the private lenders, it absolutely works. It's great for the single family home fix and flips. It's great for the smaller projects. It doesn't really work for the bigger ones, primarily because of not the legalese, but the banks and their own underwriting requirements. And then let me speak quickly to the funds. A blind pool funds, meaning, hey, we're just going to raise money, go buy stuff, or a partially identified pool. Hey, we're going to go buy this property. Then we'll go buy others that we don't quite know yet. With both of those, I kind of brought up the difficulties of raising capital with them. If you don't know what you're investing into, why is the investor going to give you money? As long as you have their trust, if you have prior performance that you can prove, the proof is in the pudding. If you say, hey, I've done all this for other investors and you lied about it or bent the truth, it could be securities fraud, which may be criminal if it's extreme. As long as it's a oops, didn't know, it may only be civil. But when it comes to securities fraud, the plaintiff's attorneys, the attorneys are always asking for, they call it treble damages, triple damages for whatever losses their investor has. So that's where having a fund too early in your business plan can be more difficult. But ultimately, when you do have that audience, when you do have that trust, hands down, it is the best, easiest strategy, because now you're not having to go through the whole process of organizing a new company and a new syndication for every deal that you have going on at that time. How to start the easiest is a real estate syndication, where you say, okay, we're going to go buy this property. You're raising equity capital from the investors. It's your responsibility to go find the debt elsewhere to put it together and make the entire business plan happen. In terms of expediency, and I know it's always a concern for people, well, if I get a property under contract, how am I going to raise all the capital fast enough? Well, as long as we're still kind of working on the deal, figuring out how to do it and where to do it, they call it testing the waters. Testing the waters is that solicitation of interest. I'm not asking for your money. I'm not accepting your money. I'm not contractually binding you to make an investment. But hey, let's be honest here. I got to figure out if I have enough interest from investors to even run down the rabbit hole to pursue this property. You're absolutely allowed to do that. And even as we're kind of working through how we're going to structure it, how we're going to deal with it, you continue to be able to test the waters, finding non-binding investors. And then once we have the offering figured out, you're ready to start accepting the capital, then it's a whole lot easier to meet any short timelines with, hey, reaching out. We got it. What we've talked to you about, ready to go. Here's the wire instructions. Here's the subscription documents. Let's make the investments happen. So I do want to thank everybody for joining us today. If you haven't noticed, I've been sharing my QR code just like every other restaurant in America right now. Zap it, save my info, reach out anytime. David, you are absolutely welcome. Looking forward to speaking to you and everybody else. Thank y'all.